The stock market is closed today, but just over the last 5 days, we are seeing a lot of companies which are down. And today we are focusing on 4 dividend stocks that we haven't heard from in a long time. These are all trading right there towards their 52-week lows. We're going to look at each company, their historical performance. We'll talk about their dividend safety, as well as their underlying metrics like the free cash flows, their ROICs. And as always, we will run every single one through the valuation model, getting to both our intrinsic value as well as our acceptable buy price, considering Wall Street and their target over the next year. And every single one of these do have some significant upside. So the first one we're looking at is GPN Global Payments. We have a strong buy from Seeking Alpha, a 5 out of 5, a buy from Wall Street with a hold from Quant. It does offer a forward yield of just over 1% and a forward P of around 7.92. S&P sits around 22.5, but as always, we will look at the sector P for a better comparison. And we do note it is pretty much trading right there at its 52-week low. Over the last year, well, you would be down 7%, so pretty poor. S&P is up itself around 25% year to date. And over the last 10 years, we can see you would be up around 154%. Bear in mind, if you reinvest dividends, you would be up slightly higher. And we can, in fact, see all-time highs do sit around 3 years ago at $220. So currently the share price is more than 50% lower than that right now. In terms of dividend safety, well, it does sit at 70. It does look to be safe. Market cap 23.5 billion. It is a large cap company. And just last month, it was reaffirmed their dividend safety score at 70, meaning a dividend cut does look to be unlikely. Now, last recession, how did they do? Well, in fact, they maintained the dividend during the 07-09 Great Recession. Didn't increase it, also didn't cut it. They had plus 6.5% sales, so very positive considering the average of the S&P was around negative 12, and they also did outperform the S&P, negative 38% return. S&P itself, negative 55. Now, dividend growth, they haven't actually increased it since 2021. What we do know, though, over the last 5 years, on average, they have increased it 90% per year. Over the last 20 years, 17%. And what we can see is whilst there are 0 years of consecutive increases, they have been paying a dividend for the last 22 without a reduction. As always, we do like to run through dividend yield theory. Now, for newer viewers, it does state a company is undervalued when the current yield sits above the 5-year average. So we have our first signal of undervaluation. In fact, today we have a double undervaluation signal. Forward P 7.7, below the 5-year rolling of 14.8. In fact, a triple undervaluation given it is also lower than the financial sector of 10.9. Just bear in mind though, we don't look at any of these models in isolation. We will conclude towards the end. As always, free cash flow payout over the earnings, which is susceptible to manipulation by management through accounting. Below 60% is our target, and look at this, it has been below that over the last 10 years, in fact below 20%, 16 in 2023, 8% expected over the next 12 months. We would like to see a very nice increase next year. In terms of free cash flow per share, well, consistent increases year on year. It has in fact more than doubled over the last 10 years. We just don't get that consistency that we do want to see here on this channel. Again, look at that inconsistency. Over the next 12 months, it is expected to double around $12.40 per share. That is a positive sign, but just something to consider with this company. It does have inconsistent increases on that free cash flow. In terms of sales growth, well, 3 to 7% is the target. Very mixed, again, very inconsistent, but pretty much over the last 5 years, we do see some very strong increases to their top line. 7% as well on a trailing 12-month basis. And when we do look at this numerically, we can in fact see they have pretty much tripled their top line over the last 10 years. Now, in terms of shares outstanding, as always, one of the things we love to see is returning excess cash to our pockets as shareholders through those share buybacks, giving you a larger portion of control of the company. What we can see here is they would have diluted your position over the last 10 years, but in fact from 2020, the highs of $301 million, they have started to do some consistent share buybacks. Hopefully that does continue into the longer term. Then when we look at the ROIC, very important, one of our favorite metrics here, essentially giving us faith management are able to effectively allocate their capital. It has unfortunately been below that for the majority of the last 10 years. It did dip to the lows of 2% in 2019, Nice to note it has started to increase, but again, last 2 years at 5% is fairly low, just something that we can incorporate into our margin of safety later on. In terms of margins, well, very nice to note, not just consistently above 12%, but operational efficiency, 16% in 2015, 23 in 2023, expected 24 on a trailing 12-month basis, and the same story to be told on the free cash flow, well above the minimum 5%, but we do see inconsistencies and it has been decreasing. Nonetheless, 17% in the more recent year is still a very good sign. We then get to the net debt to EBITDA, earnings before interest, tax, depreciation, amortization. The reason why it is one of the metrics we look at, it correlates to balance sheet strength and that dividend safety score that we saw earlier. Below 3 is realistically our target, with these are the number of years it would take the company to pay off all of their debt net of cash on hand. It's been above that for the majority of the last 10 years, in fact increasing since the lows of 2020. The only positive to note, it is expected to reduce into 2024, but we can see still above 3. Just something to consider when we do discuss that margin of safety as well as your own investment analysis. So let's jump into the valuation model. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, typically on the channel, we do run through these deep dives going through every single model. Today's episode, let's get straight into it. And the intrinsic value here is coming to $167. As always, current price 92. We'll start off with a MOS level of 10%, which we only execute on if it meets our 3 golden criteria. Wide moat, strong financial metrics, good forward-looking data. If you believe that, well, it's a buy up to $150. Then we keep going till it's near the current trading price. What we can see in today's episode, it is trading at quite a large MOS, pretty much a 45% margin of safety. Now, if you want, we can do a deeper dive with this company to understand why it has been hammered so hardly just over the last few years. But right now, we are seeing a 45% MOS level. With Wall Street, though, they are seeing a massive upside, $147 price target over the next 12 months, with 60% indicating as upside. And as we saw here, a strong buy. In fact, this is the highest score obtainable, with Seeking Alpha giving it a 5 out of 5, therefore making it one to seriously consider in the portfolio. So to conclude, for GPN, we have a 45% MOS level with 60% upside according to Wall Street and their targets. Now, before we move on to the next stock, just to let you know, we've released our latest free weekly article. If you want access to this or any other articles, all completely free, do click on the pinned comment below, instant access. For example, if you want to see the website screeners that we use on the channel as well as our own analysis, do click on this article. Or for example, 12 undervalued dividend stocks which are high quality, again, instant free access. The next one we have is Mondelez International, very similar to Hershey that we did review yesterday. Cocoa prices have really hurt these numbers, but we get a strong buy from Wall Street, a buy from Seeking Alpha, and they hold from Quant, trading right there towards its 52-week low. Forward yield 2.6% and a forward P sitting just under 19. Now, over the last year, it is down around 10%. Over the last 10 years, if you are a shareholder, you would be up 78%, and we can see all-time highs sitting there around $78. We're talking about a year ago today. Now, in terms of dividend safety score, well, we get a 66 safe score. Remember, Hershey was sitting around the 80 level. Market cap, 89 billion. It is a large cap company, and we can see just reaffirmed last month dividend safety score suggesting dividend cut does look to be unlikely. Now, key metrics, well, they maintain the dividend, again, similar to GPN. They didn't increase it, they didn't cut it. They had below average growth, but they did ultimately outperform the S&P with their negative 35% return. Nice to note, very strong increases, double digit last July, so next month we are anticipating an increase, double digit over the last 5 years. Over the last 20 though, we do see a 5% increase to that dividend year on year. Now, they have increased those dividends over the last 10 years, as we can see a double cut in 2011 as well as 2012. In terms of dividend yield theory, then again, undervaluation on both the yield, 2.57 versus 2.23, as well as on the forward P. And when we look at the sector P of consumer staples, it isn't too far off that today. So how about the free cash flow payout? Very important. This is a company that does increase it double digits over the more recent year. Consumer staples, we increase it to below 70%. Again, bar 2017, it has been below that. 61 in 2023, 57 over the next 12 months. So a good sign based on this information. So far, dividend does look safe. Now, this is quite impressive. I do like this free cash flow. It has been growing over the longer term, more than double. And again, especially over the more recent period, we do see that consistency, which is always great to see. Over the next 12 months as well, it is anticipated to continue that upward trend. In terms of sales growth now, what we always want to see for a minimum baseline of 3 to 7 is what we get over the last 4 years. But if you look before that, in fact, they had 3 years where their top line wasn't growing, and the 3 years before that, we do in fact see negative growth. Now, bear in mind, just to keep up in line with inflation for real terms, we need 3 to 4%. So it was going through a rough patch during that period, but since then, we do note the top line has been looking very solid, and we can in fact see from the lows around 26 billion, it is up now to 36. What is also nice with Mondelez, they have done share buybacks, in fact buying back quite a number of shares from the 1.71 billion from 2014 to the 1.37 that we just see over the last quarter. ROIC as well, we do increase this slightly for consumer staples to 12%. It hasn't been that much lower. It is lower ultimately though, so again, bear that in mind. But 12% over the more recent year, 14% on a trailing 12-month basis. Again, positive signs of improvements to these metrics. Margins as well. Now, yes, it is below that 16% in 2014, but it has been gradually increasing, so that's a positive sign of the efficiency we want to see. And 20% on a trailing 12-month basis. Again, all pointing towards the right direction. And with the free cash flow margin from 2018, we are seeing some very solid numbers. Again, lots of consistency, which is always a great sign to see in any company that you are analyzing or looking to buy. Below 4 then becomes essentially the metric we want to see on the net debt to EBITDA. It has been declining since the highs of 2017 of 4.04. Expected to go even lower, so I like this quite a lot. It is actually moving in the right direction with a lot of their metrics. So at a high level, it is pointing to all of the positive signs. In terms of the valuation, which is always going to be important regardless of how the company itself looks, and don't forget you can grab a copy of this model by clicking on the pinned comment below, getting to both intrinsic value and acceptable buy price. So intrinsic value $78, margin of safety at 10%, a buy up to $70, 15%, again pretty much bang on the current trading price. So for this high quality dividend company, you are getting a 15% MOS level. In terms of Wall Street, well, they anticipate the price to be even higher than our intrinsic value, upside of 22%, $81 is what they envisage this company to be trading for in 2025. As always though, let us know your thoughts as we do go along these stocks today. We then move on to NOC with their triple buy rating, again trading right there towards its 52-week lows. This is down around 6% over the last 12 months. Over the last 10 years though, it is up around 253%. We can see all-time highs around $550 around 2 years ago, and it does have a forward yield of around 2%, 1.94 to be exact, and a forward P of 17.2. Now in terms of their dividend safety, nice to know, a very safe score of 90, always great to see. Market cap, the 63 billion, a large cap company, and again reaffirmed just last month, dividend cut looking highly unlikely for Northrop Grumman. In terms of key metrics, well, they in fact increased the dividend during the last recession, great here after coming from those two previous that maintained it. Average growth during the period, and they pretty much had a bang-on S&P negative 55% return. Well, we'd love to see this, an increase this year of 10%, 9% over the last 5 years, and over the last 20 years, 12%. Already looking like a very solid company that we haven't really heard a lot from in the community. 20 years of consecutive increases as well, with 34 years of paying a dividend without a reduction. Now, dividend yield theory, we do get that undervaluation signal on the yield. In fact, one of the highest yields it has offered over the last 5 years. Forward P 16.9, marginally lower than the 5-year of 17.4, and we do note it is also lower than the industrials of 19.1. In terms of looking at the payout ratio, again important because they do pay out a double-digit increase for the majority of the period. It's been below 60% other than 2022, expected to go even lower into 2024, so I would be surprised if we don't at a bare minimum see a nice high single-digit increase to the dividend next year. In terms of free cash flows, well, we do get a bit of inconsistency here. As we have said before, this isn't really what we want to see. We want to see consistent increases over the longer term, unless you are analyzing a cyclical company. 2024, though, it is expected to have a large increase from the previous year. In terms of sales growth then, over the last 2 years looking positive. 2021, they did have a negative 3%. Prior to that, though, pretty strong other than the two negative back-to-back years of 2014, 2015. So a little bit of inconsistency here. Nonetheless, over the longer term, we are seeing growth to that top line, which is always what we want to see. And very nice to note, they have returned excess cash. They have been doing those share buybacks. Maybe not consistent year on year. Nonetheless, they are reducing that count over the longer term. In terms of the ROIC, now very strong for the majority of the last 10 years, just unfortunate that the more recent year is in fact the lowest of the last 10 years. Hopefully they can bring this back to the highs that we have historically seen in the 20s. In terms of margins then, operating side above 12% is what we want to see, not what we get consistently, and unfortunately the more recent year it did fall significantly lower. Something to keep an eye on, again factor that into your MOS level. Free cash flow margin fairly consistently around the 5% year on year. As long as we do see that maintained, that is okay. In terms of the net debt to EBITDA, very important. Remember, balance sheet and dividend safety. Below 3 since 2020 and beyond. In fact, 2.26 in 2023, 2.44 expected in 2024. So it does look to be safe. Can understand why we have that very safe dividend score, especially with that free cash flow payout looking fairly low as well. In terms of the valuation, again, the intrinsic value in today's episode is arriving at $515. And what we notice here then, current price of $426, 10% margin of safety, a buy up to $464, at 15% up to $438, at 20% it isn't quite there yet, so around a 15 to 20% margin of safety. And in terms of Wall Street, they do see around 22% upside. Their price target $518, again considering this a buy for the portfolio. We then bring you on to one of the most battered companies in more recent time, Albemarle Corporation, a double buy seeking alpha, and Wall Street a sell from quant, down 55% over the last year. Over the last 10 years, somehow up 38%. We do see all-time highs, $325 November 2022, and this is trading right there at its 52-week low now. Forward yield 1.61%, forward P looking very high at 39, but when we do take a look, it does have a very safe dividend score of 90, market cap as well 11.7 billion. It is a large cap company, and again, just noted in fact this month that a dividend cut does look to be highly unlikely. So in terms of the last recession, well, interestingly, they increased the dividend, they had below average growth, and they did trail the S&P, although marginally with their negative 63%. And we are still waiting on an increase to the dividend, 4%, so pretty much in line with the inflationary target over the last 5 years. Nice high single digit over the last 20. In terms of increases, well, they are a dividend aristocrat. They have increased those dividends for 25 years or more. In terms of dividend yield theory, well, we do get the undervaluation on the yield of 1.61, 5-year average of 0.97 as well, although we do note the forward P does sit significantly higher than the 5-year average. Again, if you want us to do a deep dive to understand some of the detail behind this, do let us know. We can see the materials itself 20.5 significantly lower. In terms of the free cash flow payout, well, what we want to point out here firstly is that it has been negative for quite a significant number of years, given they have had negative free cash flow, and that trend is expected to continue over the next 12 months. As we can see here, negative free cash flow for 5 of the last 10 years. Again, negative 1.67 expected over the next 12 months. In terms of sales growth, well, very, very large increases over the last 2 years. And in fact, over the last 10 years, although we do know some negative numbers, this does look very strong over the longer term. We do want to point out negative 4% on a trailing 12-month basis. And as we can clearly see, they have increased their top line quite strongly over the last 10 years, although the majority of the growth has just come over the last 3-year period. On top of that, they would have diluted your position over the longer term, although very marginally, and over the more recent years, it is very, very trivial. We then take a look at the ROIC. Again, it is very inconsistent. We do want to see above 10% consistently. For example, 21%, which is very strong in 2022, now 3% in the latest annual report. In terms of the margins, well, as always, above 12% is what we see up until 2023, which hasn't been the greatest year for Albemarle, and we can see on a trailing 12-month basis, negative operating margin is a little bit of a worry to note here. No surprises on the free cash flow, given we have seen it has been negative, especially over the more recent years. And when we finally do look at the net debt to EBITDA, one of the strong points about this company is their very healthy balance sheet. 1.03 in 2023, 1.18, so a small increase anticipated over the next 12 months. Now, what's really interesting with this company is the valuation, and as we were running through it, Wall Street do see this as a very strong stock. Now, our intrinsic value we have used is just on the DCF model, $121, and as we can see, we have used a growth rate here of around 7%, significantly lower than the average, which is very high, but this is lower than analysts as well as management estimates, so do bear in mind our valuation today is based on that number. And what we can see, if we are looking at a margin of safety, 10% indicating a buy, 15% indicating a buy, not too far off a 20% just yet, so we would say 15 to 20% for Albemarle, ticker symbol ALB. However, when we do come to look at Wall Street, they are very bullish on this company in the future. In fact, just over the next 12 months, they have a price target of $148, upside in fact of 48%. As always, let us know your thoughts on these companies today. We had GPN, we had MDLS, we had NOC, as well as ALB. Whether you're buying any on the watch list, or maybe for whatever reason, they're just not something you're interested in for the portfolio. And if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.